Hello, good evening, everyone. This is Kevin with Real Traders Webinar. And as always, we just first off want to thank you for joining us on a Thursday evening. We have a lot of people here, hundreds of people, and we have tons of people still rolling in. So tonight we have with us again a team that has paired up a few times in the past, and every single time they come on, they completely blow us away. So let me just tell you a little bit about them and we'll get started. So first off, we're going to have Mark Nicholas. Now, Mark, as many of you know, is the founder of daytradingzones.com. He's also a contributor to Real Traders Webinar. Mark's been trading for over 2 decades. He's been mentoring for a decade. And Mark is the creator of he's developed his own professional probability tools that provides powerful support and resistance and trend continuation indicators. Also, we have with us Kevin McClanahan, who is a principal of Merlin Capital Management. He's a third-generation trader, been trading for over 10 years, and his specialty is Emini, S&P, and SPY, as many other things. So, guys, sit back, enjoy tonight, and we look forward to having Mark and Kevin present. You guys, you there?
Yes. Good evening, everyone.
Hi, good evening, everyone. Welcome.
Welcome. Do you sound test for everyone? Can you guys hear us? Quick yes no. Quick sound test. Okay,
How is
Doug.
that?
Thanks.
Everybody can hear us?
Okay, so let's rock the boat. Okay. Good evening again. My name is Mark Nicholas. I'm the founder of the daytradingzones.com. I've been a trader just like you for almost 20 years. Started in the professional circuit as a prop shop trader and finished my professional days in a small hedge fund called JP Capital, which was the division of Andover Trading in Fort Lauderdale. I've been trading since then my own money, just like you as a day trader, working from my home and consulting and doing research and analysis for the prop shop, small hedge funds, and the retail side on providing buy zones, sell zones, and caution zones for the futures industry and the options market. Kevin McClanahan, he's an hedge fund and principal at Merlin Capital Management. He's a user of what we do, and he has been pairing with me, helping you guys doing some options and understanding the power of options to create weekly and monthly income. Those are stuff that we both do on a daily basis with real money. And so hopefully we'll be sharing with you guys tonight some tidbits. Okay. So now, quick survey in the room. Who has never traded options? Say me. Who has never been an option trader or know the power of options yet? Just to get an idea tonight how deep or slow we are starting. A lot of people have asked us to go a little more slowly. We've done those webinars about 4 or 5 times now with Kevin, and we have gone deeper and deeper each time. And there have been a lot of new people who have joined the community, and we have been told to slow down a little bit. And so, okay, so not I would say a couple of people. So. So that's going to be great. So Kevin and I are going to show you something right away and straight up. We are going to show you tonight the power of trading the SPY. Can everybody see the broker account? Quick yes, no, everyone? Okay, so today I traded the SPY. This is my favorite directional trading play instead of trading the ES, and I'm going to explain to everybody with Kevin why we like the SPY as a directional play. We also are big believers that the SPY as a directional play is not only the best instruments because there's the highest volume, the bid and ask spread on the option chain is the tightest that you can find compared to a Google, an Apple, which have large spreads, but also it is an instrument where you have so much liquidity that you can get in and out of those trades with 10,000, 20,000 shares right on the bid. See, last week I did $12,000 on the SPY, and I had about 180 contracts which is about 18,000 shares. So I had bought those contracts. So don't think it's a lot of money. Those last week were 64 cents to 84 cents. So we'll call it, for sake of demonstration, a 74 cents average. And so if you take your calculator and you take 18,000 shares, which is 180 contract times 74 cents, that was only 13,320. So with 13,320, I controlled 18,000 shares, or at least I had 18,000 SPY, compared to my average ES, where I use for one contract a capital outlay of 10,000. So we are going to come back into this. I want you to know that the strategies that we are talking about tonight, if you are new in the community, are trading stuff that we do every morning. Every morning we wake up around 6 a.m. We create buy zones, sell zones, and a plan of attack with a shift of momentum around area of interest to us, and we trade real money. So as you can see this morning, with a small size, not even a huge size, because the market move has been pretty big today, made 2,670. And I believe, Kevin, you told me, and you have a screenshot that you'll show us later on, you made what, you said?
Yeah, just in the first 30 minutes was up $5,400.
$5,400 in 30 minutes this month. Okay, so we are going to share the strategies with you, and we are going to mix it up. We are going to mix up tonight. It's a mix up. So we've done specific options webinar with credit spreads and SPY. Tonight it's going to be a mix up between the SPY and the spread. So let's go back to the basics for 5-10 minutes, and then we'll go to charts and option chains. So when we are traders, everybody, we all have the choice, and that choice is to trade at the current price, the current bid and ask price, or hunt and wait patiently for certain support or certain resistance to happen, where you have at least 68% to 95% chance of success. This is a bell curve. That's a statistical bell curve. Don't be intimidated. The point in the matter is we all have a choice with our prep in the morning, whether you look at monthly charts, daily charts, weekly charts for support and resistance, whether you look at moving averages, market profile, or Fibonacci extension, floor pivot, I don't know, whatever it is that you are watching, if you do an analysis cross time frame here to find a good support and here find a good resistance, you have a choice. Nobody puts a gun in your head to trade around that 80 and trade around that 120 versus trading the current price. And this is very key that you understand that, because it is much better that you do fewer trades per day or per week or per month and hunt for those levels where you are going to wait for a shift of momentum, a cross recross or a cross recross lower high. Those I'll show you in the charts on how to pinpoint 3 trade setup that can help you around the charts to tell you that not only this thing, let's say this thing drops from 100 down to 80. Well, it's not enough that it touches 80. You want it ideally to go below 80, back above 80. That's a cross recross, and you kind of have the shift of momentum happening there. Same for long. So I'll show you like right now on the charts. Can everybody see that chart? Because that's the basics, the premise we want to give you in about 5-10 minutes, and then we'll go through charts and real option chains and real stuff that we do. But if you don't understand the basics, a lot of people will be left out tonight. So again, we are all looking for support and resistance. But here's the most important, whether you create weekly income or monthly income with credit spread, where you sell time decay, or you do directionals on the SPY like we do, you have to wait for area to set up like this. And a big mistake that traders do between support and resistance is they go at the support, they make higher highs, higher lows, higher highs, they are long. And when they reach their resistance level, they get out right away, and they make crucial mistake number 1, they get short. And you should not get short right away. You should get out of your long. That's a good strategy, overall speaking, but it's a very bad strategy to go short right away, because the market maker, the high frequency trading system, can read the order flow from the weak hand. The weak hand is us, is the retail traders, the small sizes, and they can pretty much read the level 2s or whatever that they see in their algorithm, And what they'll do is they say, okay, if this is 1,000 on the ES and this is 1,010, let's say, what they'll do is they'll push through the round number and they'll take all the retailers' stop loss. When they reach a neutral point, they'll start shorting. When they start shorting, there's a hook that forms. And when that hooks recross the same level that you were looking at getting short, now you have a trade. Now you have a trade that you can enter with a small size. And ideally, I like the cross-recross and the retest lower high, where you put a stop loss on the high neutral point here. So that the retest can be a little higher, a little lower, it doesn't matter. The point is that the retest needs to be a lower high when it's a short. And I'll show you how this formation pinpointed exactly this morning, and this is how I made $2,600 plus. This is how Kevin made $5,000 plus. Okay? Now, there's another trade setup that we like, and you'll see it a lot of time. It's a consolidation pattern. It's the ping pong zone, which is the channel play. The channel play typically will play as follows, everybody. It will play within your trend. So if you analyze in the morning your monthlies, your weeklies, your daily charts, and you do a cross time frame analysis, and you decide that overall the trend is short or negative, then here's how it works. If you have a net buyer here, you have a net seller here, S1. You have a net buyer 2, you have a net seller 2. Here's the crucial mistake number 3 that most of the day traders do. They'll go and chase the break of that channel here, and they'll get 60% chance of losing money because look at statistics. You had a net buyer here, 1, you had a net buyer 2, and you go and short here, well, you have only 33% chance of success. So the buyer 3 comes, and this is where you want to hunt for your trade. On the third touch at S3, you want to short here with the high candle stop loss within the direction of your morning analysis. Does that make sense, everybody? Quick yes, no, because those are powerful concepts, and believe it or not, it happens every day. So let's go to charts right now without due, and then we'll go back explaining to you the power of the SPY and how we create weeklies and monthly income in about 45 minutes within the time that we have tonight. So now, let's go to the chart. Can everybody see the chart? The trend navigator, please. Quick yes, no. Okay, cool. So here's what happened. So if you look at the ES, we are going to take the ES and the SPY, shall we, Kevin? Just focus on those two.
Yeah, that's a good way to start. And don't worry, we'll talk about what to trade. Okay. We'll talk about the different strikes to trade and the weeklies and so forth. We'll talk about that here in a little bit. I want Mark to really give a thorough introduction here to these levels, all right, because we're initiating trades, all right. We're taking our profits and we're initiating new trades at these levels. Go ahead, Mark.
Okay, so let me explain. So whether you use and understand the tools here, it's not the point. The point is we want to show you the trade setup that you can use with your own support and resistance. And in addition to that, we want to show you how it works. So again, you come in the morning, we use some MACDs, 619.9, fast MACDs, and we use the slow MACDs on the full Pro tool, which is right there. Can everybody see those settings, which you can write for yourself? 619.9, 12.26.9. Ideally, when both MACDs are crossed, on the slow and the fast, you have a perfect synergy of trend. Okay? So now, here's what happened. So you can write that down. Those are absolutely free. You can get them on any chart platform, and they are pretty cool. Okay? So whether the strategies that we are going to teach you tonight works for day trading and investing and creating weekly and monthly income. So if you have jobs, who has a job and is not a day trader? Tell me, just curious tonight. Who has a full-time job, is fascinated by trading or option strategies, but is not a day trader, is not in front of a computer all day long? Just curious. How many people in this room? Oh, look, Kevin. Interesting. Here it is. Let's go back to the Trade Navigator. So here's what happened on the Trade Navigator. Every morning, whatever is it that you trade, everyone, you got to create your analysis. You need to come, look at your monthly charts, look at your weekly charts, look at your daily charts, look at your 60-minute charts, look at your tick charts, whatever is it that you look, and you want to look for synergies and find numbers that keeps on popping up for good support and resistance. We do that work every morning. I wake up at 5:45. Usually it's me or Mike, one of my 30-year trader, or Jack. And what we do is we look within the Pro Tools that you see here, where you see clearly, let me show you clearly the way it works. There's a up arrow here for shift of momentum, immediate trend change, up, blue dot for continuation, or this morning, down arrow, pink dot, 60% of the continuation trend from major resistance to dashes to major support the dashes. So you see, they made the entire move here. And within that cluster really. And if you look carefully, this is also a double top from last week, 73. Can everybody see that? So you have your trade formation, which is a double top right there. And then also you have the cross, recross, the shift of momentum of the important zone from important resistance to important support, okay? To the tick, by the way, on the support side. So when we came this morning, we take all those full Pro Tool and concise them into analysis that we put in the morning, and the green zones are the buy zones, the orange zones are the correction zone, and the reds are the sell zones. What we typically look for is a shift of momentum on the buy zones to look for a short, or a shift of momentum on the sell zone to look for a long. So like a cross, recross, a retest higher low on the sell zone, or a cross, recross, a retest on the bottom of the caution zone. And here we go for a shift of momentum. So when you have those area, you have two choices as a trader. Choice number one, you can trade the ES, and choice number two, you can trade the SPY. Okay? And you have three choices, as a matter of fact. You can trade the stock, the SPY, which is 175 bucks. You can trade the ES, one contract, which will require about $10,000 in capital. And what you have to understand is the equivalence between those two. So let me give them to you quickly. And then I'll prove that in the option chain. Can everybody see that slide? Quick yes, no, it's very important that you understand the importance of equivalence. So here's what happened. If you trade futures, the ES, you got to know that two contracts of the ES, which requires about $10,000 a contract to trade safely, because most of the people use 2-point stop loss, which is $100. And typically, when you trade futures, you don't want to risk more than 1% of your account on each trade. So $100 is 1% of the $10,000 a contract. So to trade safely 2 years, you need $20,000 a contract. That equals 10 at the money weekly options on the SPY, which equal 1,000 shares of the SPY, which we just seen at around 175, 176 today. Okay. So if you were to trade 1,000 shares of the SPY, that would require a capital outlay out of your pocket of $175,000. So obviously this is not capital efficient here. Now if you were to trade 2 years, we just said that's much better, that you improve is $20,000. But here is where the real power comes in. If you trade 10 out the money contract, but you get in and out and flat at the end of the day, on the SPY, you can get those between 60 cents and $1.50 usually. So average, let's say about $1. $1 on 10 contracts is 1,000 shares, is $1,000 in capital requirement, which leaves you $19,000 more to use compared to the ES, to use into selling weekly options or selling monthly options, and use time decay to create weekly and monthly income. So I just show you that with the same amount of money that you trade 2 years, you can not only trade directional with $1,000 only, the SPY on the weekly options that out the money options, but you can also use $19,000 to use strategy that have 68% to 95% chance of success, like credit spread, naked puts, double diagonal, stuff like this, that provides you income and time decay. Okay? And here's the risk. So what is the risk on one scenario? What is the risk? Same risk. 2 point on the ES is $100 per point, is $200 risk. When I trade the SPY, I use 20 cents stop loss. 20 cents stop loss. So same risk, 19 times less capital. Now look at the potential expectation and profit. On a good day, a good ES trader is going to make, let's say, 4 points, and even that is stretching. 4 points is $200. $200 times 2 contract is $400. $400 profit divided by the capital requirement of $20,000 is only a 4% return. So let's say there has been a great day like today. Let's say there's a great day like today, you know. Look at what happened. Let's say you were a genius today on the Eminis and you made $500, which is 10 point ES. Yep. You made 10 point ES today, and times 2 you made $1,000. $1,000 today divided by $20,000 capital requirement is 10% return. Let me show you what my option did this morning with a small account. I had no more than 50 contracts. Look, 50 contracts was less than $5,000 because I got them around 84 cents. So look at this. So let's go back. Do you guys see the P&L? And then nothing is a left-hand turn on this P&L, by the way, because I took puts all morning, and at one point I got a pull and a put, and I got a loss here because the first 40 minutes were tough, and then we caught up with $4,000. See, everybody? So as a trader, you have winners, you have losers, of course. The key is to finish winner, obviously. So look at the ones that I've made money, which is the 177.5 put. So again, like Kevin says, I want to show you a couple of things. This option expires tomorrow. Look at the type of volume that we are looking at here. 80,000, 145,000 contracts traded today. Do you guys see that? Look, 145 on the 174s, and the one that I took, let's expand the strike to 10. I took the, which one, the 77.5, Kevin? Which one did I have?
Yeah, deeper in the money. 77.
177. 177.5. So when I took that trade this morning, right there, at 84 cents, everybody, 84 cents, 90 cents, the delta, which is the probability of staying in the money, or the correlation, was at 65, I think. And look what it is at the end of the day, 86%. Can everybody see that? Quick yes, no. Look at the graph now of this option for the day. So $2.35 to $2.55 at the close. Look at the chart and the behavior of that option for today.
300%.
I'm not sure why the chart doesn't show up. They don't like the French accent tonight.
It's a 300% return.
Look what happened. 60 cents low, 60 cents low, to a high of 247. I took the trade between 84 cents and 95 cents, right there. Can everybody see that? That's my entry, right there. Yep. And this trade went right away to $1.50 and I was done. So I was pretty much like Kevin. 11:30 a.m. This is my sweet spot where I finish usually. Yeah. This trade went to a $2.70. Okay? And I didn't have a lot of contract. I started 10, 20, boom, boom, and I shifted to 50. My capital requirement on that trade, just that you know, was $4,200. $4,200, okay, versus a $10,000 capital for the ES. On the ES, you would have made 10 points, and you would have looked like a genius at $500. It's 5% return on your money. Here, I went from 84 cents to close to $1.50, which, as you see, I made over 50% return on my money. So I just showed you that compared to the ES, compared to the ES. It's a 10 times better return, same risk, less capital, which in fact is, in this particular trade, it was 2 times less capital. If you wanted one ES would have been 5 contracts. Your capital requirement would have been $400. $400 versus $10,000 is 20 times less. Do you understand, everybody? Because this is huge. Huge, 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 everybody, what I'm showing you. This is huge because that can change your life. Instead of pissing around with the ES, now you know what instruments you need to do. So the next questions that always come, but I don't understand. You said that you are an options trader and a futures trader. Absolutely. I trade the crude mainly, if it's futures, or the TF, or the 6E. Like today, the 6E had a great move down to the support of the day trading zones and across recross. It was a beautiful move, which if you look at the trade navigator right there, we call perfectly here on the shift of momentum. Let me pull. Well, this is not on this chart. I would have to pull. Don't know if I can do this and just do a 6E and see if it'll show up as it loads. Hopefully it loads and I'll show the zone. Look at this. Isn't it a beautiful analysis? Look at this, everybody. We called the bottom here by 21 ticks. This was the bottom. Soon as the shift happened, I cross, recross, vroom, $1,400 back up. You know, and same here on the morning action. You know, same on the morning action. I don't know why this keeps on moving, but look what happens here. Look at the entire flow of the past few days. You have your cluster high, cluster low, day trading zones pattern number 4. Here, third touch here. Cross, recross, retest lower high, sell zone to buy zone to sell zone. They try one more time, one breath, retesting the caution zone, this morning, and ploof. Can everybody see that? Quick yes, no. Because this is not a screenshot that I'm giving you to look good. This is a real ninja chart, you know, that are real time, but you know. Does that make sense? So if you know where you are going to have shift of momentum and you have action zones where you can buy, sell, and use them with the right probability of success of 68 to 95% chance of success, you are already 95% better than all the 90% of traders that lose money day in and day out, everybody. So let's go back to the option chain. Now, this is one strategy that we do day in and day out on the SPY. Do you want to add something, because you do that every day, Kevin, if you want to come back to the option chain?
Yeah, go ahead and go back to the option chain. Okay, so when we're talking about at the money, all right, then we're talking about approximately 50 delta. Well, what does 50 delta mean? That means for every dollar move of the underlying, you're going to put in your pocket 50 cents, all right? And so when you're looking at an option chain, you want to remember that we've got that you've got time decay that's accelerating the closer you get to expiration. So if you folks remember your expiration curve, it steepens as you get closer to expiration. And so this option chain here this week has got 1 day left, right? We've got this expires tomorrow, Friday, for all intents and purposes. Okay, so what we want to do is, for inexperienced traders, you want to give yourself the gift of time, which is, let's go out to the next weekly options, which is 8 days out. All right. Now, professionals use, you know, front week, all right, really until pretty heavily until Wednesday about noontime, and then we'll give ourselves the gift of time and switch out to the next weekly option, right? And so so time is not accelerating as quickly for us. So if you're going to be in a trade for an hour or two, then time is not collapsing. Time value is not collapsing on you as quickly. Also, when you choose a strike, now it's after hours, so these strikes will have widened a little bit. But let's look at that 175 puts. You'll see that the bid-ask spread is 121 by 123. All right. So that's, sorry, Mark, in this in this next week, 121 by 123. So when you go to exit your trade, all right, I would encourage people to get out at the market at a certain price. Okay, so have the trade desk help you with this. All right, what are you giving away? You're giving away a penny when you go to exit. That way you're not screwing around trying to get filled on a limit order. All right, you've got your target set. You know what your DT levels are, your day trading zone levels are, and so you know what your exit's going to be. So after you get filled on an order, all right, let's say we get in at 122. All right, we get filled at a limit order. Then go ahead and put in your closing order right away. All right, at this price, I want to exit at the market. All right, and when you have a penny wide or 2 penny wide spread, you're giving away a penny to exit the order. All right, to exit the trade. So that's one thing that'll save you guys a ton of time. All right. The other thing is that the professionals are looking for about a 70 delta trade. All right, but you can trade any of these strikes as long as they've got volume. Now you'll notice that the 175.50, not on this week, but on this next week with 8 days to expiration, the 175.50 puts have very little volume. Okay, so you want to go where the volume is at. See that zero
open interest.
Yeah, zero open interest and lower volume, whereas the strikes above and below have got a narrower bid-ask spread and they've got greater volume. You want to go where the volume is, and you want to go with a narrow bid-ask spread. Okay, and you can pick any delta from 50 all the way up to Mark trades 85 to 90 delta sometime. Okay, so if you will look at that bid-ask spread, make sure that it's a tight and narrow bid-ask spread. Look at the volume, that'll confirm it. And anytime you're doing a directional, give yourself the gift of time, right? 8 days to expiration, and the lower the delta, the more you can open up your stop order. Okay, so if you're going to get stopped out, a 2-point stop on the ES is 20 cents on the SPY, and so what we do is we'll trade with 5-point ES stops. All right, so that our probability of getting stopped out is much less, and our probability of profiting is much higher. So with a very, very tight stop, the amateurs are going to get stopped out more and more, okay, more often. But as you get a sense of direction, all right, with what the market is doing, and you enter at these day trading zone levels, all right, and you give yourself the gift of a higher probability, and you open up your stop so that you don't get stopped out, then you're really increasing your probability of making money every day.
There's good questions, guys. Hold your questions. We are going to answer all your questions within the next 20 minutes at the end of the hour. For the people who want to stay, we'll do a Q&A for about 25 minutes. But there's stuff that we want to go over so that we are sure that you get the SPY side and the weekly and monthly income that we create. So people say, do you sell options? And do you create income with selling options? Yes, and I'm going to explain the basics right now. But to recap quickly, one thing from Kevin, which is important, if you don't trade the SPY, unfortunately, we really recommend, in fact, we are not in the business of recommending, we tell you by experience of blood, tears, and trading every day our money, that the best directional option play on the weekly, meaning you buy the option, and you are fighting against the time decay, you are fighting against volatility potential going against you, the best instruments is the indices, the SPY, the IWM, stuff like this. It's not going to be a Google, it's not going to be an Apple, because the bid and ask spread is in the favor of the market maker. Like Kevin mentioned, look at the volume today on the out of the money options, 103,000 contracts. And here, look at the open interest, 49,000. So when I come in and out with my little 50 contracts or your 10 contracts or your 5 contracts, this is completely absorbed properly in a matter of seconds at the bid. Last week I made $12,000. We sent a video on how it was made on the same SPY. And what happened is I sent at one point 120 contract or 180 contract, which is 18,000 shares, everybody, in a split of second on the bid, and I got filled right on the bid. Like, so let's say, for example, would have been 50 cents. On other markets, the market maker, and because of the level to depth, there's no volume. So it could be 50 cents here, it could be 48 cents here, and it could be 40 cents here. So the market maker, when you shoot the market order or the market order versus a limit order, he's going to fill you the 180 contract by wiping out this. So you might be filled at 40 cents, 48 cents, 50 cents, versus the SPY, you get filled right away on the bid because there's so much volume, so much open interest. Let me show you Google or Priceline. Look at Priceline, everybody. Look how many contracts are traded. Can everybody see the difference? Look at this. It's very telling. There was like 140,000 contracts traded around the at the money. Look at this one, 266. You compare 266 contracts in volume compared to 103,000 contracts. And look what happened now. Look at the bid and ask spread of those crazy stuff. $2. We don't want to be the sucker paying $2 between the bid and the ask. Does that make sense, everybody? Quick yes, no. Because if you understand the power of the SPY versus the ES for a first touch reverse, that you understand that you need to stick to it because there's a lot of volume, there's a lot of liquidity. The bid and ask spread are very thin versus a PCLN, a Google, and an Apple, where the market maker kills you here. 8% of your money. So you are not even in and out, that you're already being screwed 8% of your money. So now, the question is, if the buyer gets screwed $2 here, who is making the money, the buyer or the seller of the options? And we are going to transition to the weekly and monthly income and stuff that we do. Who is making the money? You, the buyer with a 2-point spread, or the guy who sells it to you with a 2-point spread? Give you 2 minutes. Da-da, da-da, da-da. Tick, 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 tick. Of course, the seller. And for the people that don't understand why selling option is where it is at for most of the professional, I'm going to show you right now with a slide, and then we'll go back showing you some of the cool stuff we do. Can everybody see that new slide? Quick yes, no, everyone. So this is pretty much what I want to show you. If you want to flip the card, so the way that we do it, and Kevin might do it differently than me, but the way I allocate my capital is as follows. 70% of my capital, I keep on hearing you moving. Okay. 70% of my capital is dedicated into selling options. And the reason I want to sell options, you are going to learn now, is to create weekly and monthly income and take advantage every day, Monday, Tuesday, Wednesday, Thursday, Friday. I want to know in a predictable fashion when I sell options how much money is decaying in that option and coming into my bank account or my broker account every day as a profit. So here's what happens with options. So let's see if we can go back and explain to everybody the power of selling options. The reason you want to dedicate most of your capital into selling options versus buying options, and we showed you a cheap way to substitute your futures into the SPY. And usually you can do that, like I said, with a minimum of $1,000. You don't need more than $1,000 to start, and even $500 to start the strategies we showed you on the SPY to prove yourself between 1 and 5 contracts. And when you prove yourself into 1 and 5 contracts, you do like the people at the gym. You start building up your muscle and your emotional memories and your financial memory to build up back up more size to get more money, obviously. Here's what happens when you sell options. If I buy today a $1 SPY option or Apple option, and the option today shows me within this one box that there is a time value, so that the option is in the money, real value, let's say of 25 cents. And let's say it shows me a time value of about 70 cents, which is 95 cents total. And there's, let's say, volatility. There's 3 components in an option: the real value, the time value, and the volatility. And let's say the volatility is 5 cents. So what happened essentially on Thursday, knowing that your option expires tomorrow, if you take an overnight with $1 that you pay, you are sure that tomorrow that $1 will be only worth 75 cents. Because that 25 cents, no, that 70 cents, sorry, that 70 cents right there in time value is going to be down to 0 by expiration, which is tomorrow, on Friday on the weekly, which means that the real value of all your options by the end of tomorrow is 30 cents. So you are essentially the sucker who just bought an option for $1. Someone sold it to you for $1, but the true value of the option by tomorrow, by the time the time value evaporates, is 35 cents. So now, who won? Who is the winner here? The guy who bought the $1 and stay overnight and let the time value crush against himself, or the person who sold that option to you? The seller. Exactly. The seller is the person who makes the money. And that time decay, that 70 cents, that time value, decay every day. So on the weekly, it's like Monday, Tuesday, Wednesday, Thursday, Friday. And what happened is, like Kevin has told before the event, on Monday, Tuesday, they are relatively flat, a little down. But there's an acceleration on Wednesday, bigger acceleration on Thursday, and to 0 on Friday. So what most of the people do when they start selling credit spread with 68% to 95% chance of success, they start selling their option on the last hour on Tuesday or the first hour and a half on Wednesday, and they let that thing decay, and they start covering their option towards the last hour on Thursday. If you have 66% of the premium, so let's say you sold an SPY 1 point spread for 33 cents, and it goes down on Friday to 10 cents, or Thursday afternoon at 10 cents. If you have 60% of that 33 cents, I usually get out. Mm-hmm. I don't take the risk to keep my spread overnight on Friday, and I redo it again next week, Tuesday, Wednesday, for the following week. And every week, ching ching, you make money with 68% to 95% chance of success on your spreads. So you might do 10 spreads, and you might have 7 to 9 spreads making you money, and 3 to 1 spread losing you money. So long you know to structure properly the proper sizes on each spread, look for the right premium on the spreads, and you have the right directional bias of support and resistance, you can do it. Because like I said, the standard deviation here that people look like, let's say you look at the standard deviation on Tesla, TCLA. Well, this standard deviation, if you had looked at the standard deviation, let me show you, 14, all strikes. Let me show you the standard deviation of staying below the 170. Now it says there's 100%. If you had looked 2 days ago, the probability of staying below 170, 3 days ago when the stock went testing the day trading zone's resistance dashes, it was giving you less than a 25% chance of success to stay below 170. So the standard deviation, the 1 and 2 standard deviation that a lot of traders use to create their spreads and to increase their probability means jack crap. If you look at them during earning seasons, they mean nothing. This is more solid. This, when you do your analysis, which look at many data through many years of data, and you look at those, you have a better accurate view of where it is in the cycle of the cross, recross, retest, and where it can go. But nobody could predict when this stock came the night of earnings with a cross, recross, and a retest of the day trading zones there, lower high at 180, and then recross the 170, you would have looked at your deltas, and the deltas would have told you, oh, the probability of staying above 170, 165 is 70%. So a lot of poor people, they went and do put credit spread around that 170, 175. The earning comes and boom, you got killed.
Max loss. That's right. And Mark and I have gone over the parameters of iron condor trades going into earnings. So review those videos, and I'm sure that we'll be going over those again. We've got 2 6-hour sessions coming next week, so we'll probably we'll have time to review those parameters for iron condor trades going into earnings. Okay.
So it is very important that you understand why you understand why we love selling premium, because selling premium is where the game is at. Most of the pension funds, most of the traders, most of the smart traders use time decay and sell premium. And so one simple strategy that we've explained with Kevin, which we've done hours and hours of free classes here within the community of the Real Traders webinar, was the credit spread. The credit spread is a great trade because it allows you, so let me show you a trade. Let's open a blank chart, or let's go back to a cleaner chart, maybe on the Trade Navigator board of Apple. So let's say you look at Apple here for the past few days, and you see the cross, recross, retest of the buy zone, and that failure here on Apple. So cross, recross, retest, lower high, failure of the buy zone, retest again the buy zone failure, caution zone retest failure, boom. So we as traders have two choices. Let's say you are bullish on Apple and you want to get at 515 or at the low at 512 this morning, which the charts didn't look great. And I have a very important area here on Apple at 505 area. So let's say we know that the 505, 500 area is a very important area on Apple. Well, most of the traders have two choices. You can start buying debit spreads because the volatility is low, so you buy debit spreads. But there's another way you can do this. Instead of gambling, you can let the trade do whatever the trade is going to do, so long that you know that the 505 and the 500s are key. And start looking at levels here and say, okay, I know the 500, 505 are key. What about if I do here a put spread, which is a bullish strategy at 490, 485, and so long I stay above this level, which is 490, and let's say you get $1.65 for it, which is 33% of the width of the strike, which is the amount you want to receive for your credit, generally speaking, to be worth the risk. So long we stay in that above that blue line, the options market gives you a great strategy called the credit spread. And that credit spread is fantastic because instead of being the gambler that trade here, the bid and ask and say, hey, if the unemployment report tomorrow is terrible, it goes down. If it's great, Apple is going to rocket back up. You could have come today as Apple was coming down, 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 which means that the put premium are going up and up and up, and start selling some put at 490, 485. You can buy a little duration, let's say December or whatever. So let's say they come and test you or cross, recross, and come back up. But you know this area on Apple is very solid, 490, 485, or 490, 495, or around the 500. And this credit spread is a very good strategy to start entering a trade instead of chasing the perfect top or the perfect bottom with a 68 to a 95% chance of success. So let's go to the option chain. Here's the first step that we do. We pull Apple, APL. Can everybody see the option chain? And we are going to look at a little bit of time. And let's say we look at 43 days or 29 days. See, because I have a position at 43 days. So I put my money where my mouth is again. And let's say we pull 14 strikes. And we look at the strikes around what I told you, 490, 490, 495. So the first thing that you look on the single options is what is the probability of staying above 495? It's a 63% chance. Can everybody see that? Quick yes, no. Quick yes, no. So ideally, we want to be here. One standard deviation to and over, which is 66% to 95%. So any of those are suitable, but you need to have enough premium. So I do credit spread, vertical, and now it's going to give me the premium. Well, ideally the 485, 490 is a grade 1 here, but do we have enough premium? If you look at monthly credit spread, you want 33% of the width of the strike. 33% of a 5-point spread, it's $1.65. So let me show you the thing. $5 spread, you want $1.65. $2.5 spread, you want about a $2, what is it? 70 cents?
Yeah.
70
70
cents.
to 75, yeah.
70 cents. For a $1 spread, like the SPY, you want 33 cents. That's 33% of this number. This is 33% of this number. This is 33% of this number. Typically, you want to sell those monthly between 30 and 45 days left to go before you sell them, because the acceleration of the time decay is between 30 and 45 days. So if you do a 60-day out or 90 days out, it's not going to help you. Does everybody understand so far? Quick yes, no. We have hours and hours just on the credit spread. We just want to mix it up tonight, so it's pretty cool with everybody.
Something to think about as well, folks. A 5-point wide spread, the risk on a 5-point wide spread is not 5 points, right? It's 5 points minus the credit we've received. Okay, so keep that in mind. So max loss on something like this on a 5-point wide spread is not the full $5, not the full 5 points. It's $5 minus the credit that we've received, which is $1.65. And when we go to take these down, we're looking to take them down about 10 days before expiration. All right, about 10 days before expiration. That's what I'm looking for. Go ahead.
You mean to cover them?
Yeah, cover them. Yeah.
Okay. Okay. So this is for the monthly, guys. And the most important thing that you need to know is how much premium I'm looking for. Do I have high volatility in relationship to the 52-week high, 52-week low option statistics? If it's high, it's better to sell the credit spread. What I do sometimes is if the volatility is in the average range, look what I do. I do a little trick. I do a debit spread. If I am bullish Apple, I could do a debit spread long-term with duration 500, 540, April 2014. And guess what? I'm going to reduce my cost basis of that debit spread, not only by the debit, by buying the call and selling the call, but also by doing a credit spread. So I attack the time decay, the volatility and everything in two fronts. I do it with the debit spread by buying and selling the calls, and I sell a credit spread. There's so many variations that you can do when you trade. The point of the matter is, for the people who are new at this, is this. Do not forget this chart. The most important thing in credit spread is where is your break even? Where are you going to start making money? The beauty of a credit spread is if you assume Apple goes up and Apple does not go up, but during the next 45 days or 30 days before expiration, Apple goes up a little bit above my break even, back up, sideways, I don't care. I don't care if it goes sideways, up or down. I will still make the full amount, the full profit, so long it stays above the break-even for a put spread, which is bullish. Or if you are bearish Apple, you could have done a call spread, let's say, and look at a call spread 545, 550. Okay? So long you hold here for the week, if you do weekly options or monthly options, this is the key. This is where you are making the money, and so long it stays below your break-evens, you are not being in danger. So the beauty of a credit spread is you are not trading anymore. You become a businessman. You become a business person that knows that out of 10 trades, you'll make 7 to 9 trades right, and you'll lose 3 to 2 trades. So long your winners are superior to your losers, cash flow wise and size wise. There's ways to adjust size, but we don't really have the time tonight. You will always come ahead. And the point of the matter is you can do credit spreads weekly for weekly income and monthly. The weeklies are a little more dangerous because you need your directional bias to be right. The monthly I like better, and they have higher probability of success because A, I get 33% of the width of the strike all the time. The weekly gives you that type of premium for earnings only because the volatility pumps and then deflates. But on the monthly, it's more predictable. On the weekly, you really better be right on your directional. But what I love about this, you don't need to know if Apple is going up 5 points or down 5 points. So long it's within the 30 points here and the 30 points here, you will make the money whether it goes up, down, and sideways. And now essentially what you are discovering is why hedge funds, professional traders, and guys like us, even with smaller accounts, we do it all day long, guys. We do it all day long because those are weeklies and monthly sources of income for our portfolio. And with that, we take a little risk with the SPY directionals. Those are two very powerful strategies that we do every week, every month. We do more complex stuff. Of course, you need to know your trend for all of this. You need to know your actions on buy zones, sell zones, and buy zones. But the point that we share with you is those things work, and they help, and we trade them every day. Point in case again, made $2,000 this morning with the SPY, and $2,600, which doesn't look a lot, but considering that the size was not huge and made over 50% return on my money right there, it's not bad. And Kevin did the same trades and made $5,000 plus in 30 minutes this morning. So those works, guys. They works. You just have to learn them with small sizes.
Mark, go ahead and put that chart back up of Apple.
Yes.
So the reason that we started with directional trades and talking about days of the week, Monday, Tuesday, Wednesday, Thursday, Friday, and time decay is so that when we do start talking about selling premium via credit spreads, then this concept of time decay might sink in a little bit more. On this Apple chart, when we are in this gold zone or the what I call the chop zone, right, of indecision, then to put on a credit spread both above the market and below the market, so a call spread above or a put spread below, and to sell premium, banking on the fact that that the Apple chart is going to, the price is just going to chop sideways, is a good bet. So look at the 5th of November there. We had a spike high that failed to go higher. Yeah, there you go. So we had a spike high that failed to go higher right at the top of this cautionary zone. All right. So the next day, and so that was Tuesday. So the next day is Wednesday. Is that correct? 5th? Yeah. So the next day is Wednesday. So what we're looking to do after the first hour or so of trade is to sell some premium. All right. So we know when we want to sell premium. Okay. Wednesday about noontime Eastern. Okay. Or after the first hour or so of trade. All right. Time is going to accelerate into Friday's expiration for the weeklies. All right. So if you want to initiate a trade, you know when you want to initiate the trade. And if it turns out that price is at the level that you want to initiate the trade, so you have both the time that you want to initiate the trade and the place that you want to initiate the trade. All right. The very next thing is to choose the correct trade. All right. So now Am I going to sell premium or am I going to buy a directional put? All right. If it's expiring this week, then now you have the answers. Okay. If it's expiring this week, then time decay is too rapid. All right. I'm not going to buy a directional put for this week. All right. Well, man, I'm so bearish. I'm going to wet myself here, you know. So I'm really excited about this bearish move. Okay, well, fine, but get away from this week's option chain and go into next week's option chain. All right, with 9 days to expiration. All right. So if you got to trade a directional put, then pick the correct one. Don't trade this week. All right. Don't buy a put for this week because time decay is too rapid. Well, what are we going to do? We are going to sell a call credit spread. Okay. We're going to sell a call credit spread above the market. What does that mean? Well, above current price. Well, how far out are we going to sell? Okay. So, Mark, go ahead and pull up that option chain again, please. For Apple.
Oh, sorry.
Thanks, buddy. All right. So what we want to do is we want to take a look at 1 or 2 DTZ levels above current price. Sorry, go back to that Apple chart again.
Mm-hmm.
So I've got a DTZ level at 542, right? It's 2 levels above current price, okay? Which when you're guesstimating this, you can say it's 2 standard deviations out, okay? So if I want to sell the 545, 550, what kind of premium am I going to get? Go ahead and go back to the option chain for 545, 550, all right? 545, 550. That's fine. This is fine right here.
You get about $1.15 mid price here.
Yeah, so not too bad. And if it was yesterday, right, when we were putting this on, I guarantee you that we're up in the 155 to 175 credit for this. Okay, and that is what is the probability of that? This actually looks like it's about a 30 delta. Okay, so my chances are pretty good here that I'm not going to get that we're not going to get price that zooms up there. Okay, and that this is going to expire with a full credit. So anyway, I want you guys to start thinking strategically, okay, about what kind of trade we want to initiate and when we want to initiate it. Okay, so now Mark does mentoring sessions, and I'll come in, I'll pop in, and I'll answer some really specialized questions, all right, for his mentoring students, and they are very specifically about, hey, what are we going to trade and when are we going to trade it? All right, Mark is answering those questions all the time, but then I'll go into technical stuff like, are we having a MACD divergence here? Is this a KISS play? I mean, I've got some really specialized old school type plays, but when you put this in conjunction with the day trading zone levels, then this is some very powerful stuff, and we're nerds for probability, okay? So we can tell you what is a high probability play and what is a dippy-do, loser of a play, okay? Guaranteed to lose you money, all right? So probabilities, you want to put them in your corner when you're trading.
There's a lot of questions. Let's go through some questions. So again, great questions. On the weekly income, we understand the weekly. When you structure the credit spreads, you start on the cycle again on the weekly. Monday, Tuesday, we do the last hour on Tuesday or the first hours on Wednesday. We try to cover them at 66% profit on Thursday for the spreads. You got that. We are looking also on a 5-point spread. Usually if I do those, I do a 5-point spread on Google and the Apples because I want more premium. You are not going to do an SPY on those. Weekly, you have not enough premium. I look for 80 cents or more. That's number one. Number two, when we do the monthly, I do a lot of SPY, and I still do some Googles and Apples monthly with more directionals. those, like I said, they start decaying, meaning the time decay start going in your favor down at about 30 days to 45 days is the sweet spot. Meaning what? If you start doing a spread today for credit spread for January or something that is over 45 days, your capital is being frozen because it's not going to really move in terms of time decay. Remember, if you are a seller of options and you sell the credit spread, everyone, you really, really want the time decay in your favor. 30 days to 45 days is the sweet spot for the monthly credit spreads. Now, we do a lot of other strategies, but we want to familiarize you with one of these year strategies, which is the credit spread. And I believe if you go on the realtraderswebinar.com, guys, and Kevin can confirm that, we have podcasts ready that they have done about the stuff that we've done, I believe, Kevin, correct?
Yeah. I mean, the webinars that we've already given are posted there, and we're going to be going back over this stuff as well in future webinars.
Okay, so let's take some questions. You see the questions like me, or you don't?
I cannot see them, but you can read them out loud.
Well, ideally, you should see them, so hold on one sec. We'll put you on organizer, but you have to be very careful when you leave. Hold on one sec. Can I put you, or Kevin has to put you? It's okay, don't even stick Kevin. Hold on. Okay, we are going to change you also as an organizer, if I can do this. Yes. Okay, thank you, Kevin. So, yeah, we have two Kevin. So, here's a couple of questions. Please, guys, one question at a time. There's so many questions coming through, and we really want to try to help everybody as much as we can. Okay, Ashwin, let's start by this. With low implied volatility, is it safer to sell credit spread? Do you look at implied volatility rank? We do, Ashwin. I mean, typically you want to sell high volatility and buy low volatility, but there's times right now where we have overall a low vol environment, and we will, at the average of the year, I would do what I told you. I would do a debit spread and still do an out-of-the-money credit spread to reduce my cost basis on the debit spread. I would do a long-term duration debit spread with a short-term credit spread that I can do every week, depending on the stock, or every month to reduce the cost basis of the stock. So hopefully that helps. Next
Mark,
one.
pull up the options chain and show them where it says today's options statistics. Okay.
Yes.
We'll speak in generalities about buying and selling.
Yeah, and I want to be very clear, guys. We are not broker specific. It's just I have a small account on TOS that I have fun with, but I do a lot on the Interactive Broker, guys. I mean, I like Interactive Broker for a very obvious reason, the commissions. Because what you have to be very careful, and a lot of people don't teach you that, because A, they don't trade, B, they don't understand that, is the impact of commissions, and we'll show you that in an instance. This is the option statistics. You have that also on IB, where you can look at the 52-week high here on Apple, implied volatility, which is 45%, 52-week implied volatility 21%, the current implied volatility is 22%. So is that towards the high range or the low range of the year? Low range. So if it's better, it's towards the low range, you want to buy options, because if there's expansion of volatility, your credit spreads might not decay as fast as you can. But that being said, if I do a debit spread on Apple, if I am bullish, let's say I buy a 500 call, and I buy a 500 and I sell a 540 call. So I buy the 500, I sell the 540, it's called a debit spread. This time we pay for that. So let's say I have a debit of $12, right? And let's say for the week or for the month, I can do a credit spread out of the money with a 70% chance of success way out towards the 480, 495, right? And collect a buck or a $1.65 every week or every month. That reduces the cost of my debit spread that I buy for long term, let's say for April. Does that make sense, everybody? This is a trick I do. I do it all the time. All the time. If the implied volatility is low, fine. I'll do the debit spread. But you know what? I still do the credit spread. But it will have to be way out. just for cost reduction. Does
Okay,
that make sense, everybody? Quickly. Yeah.
One thing I want to throw in there. Okay, so just write this in your notes, guys. All right, that we want to sell high volatility. All right, you want to sell high volatility. All right, so that's one thing to keep you on the straight and narrow. And then remember, when you are putting on these credit spreads, if you're trading either directionally or you want to put on a debit spread, then call the trade desk and tell them what you want to put on, so that you don't accidentally close out one side of your spread, all right, by choosing to buy something that you've just sold. Okay, so the trade desk, that's part of your team. They're an extension of you. All right, get to know people on the trade desk. Feel comfortable picking up the phone and calling them when you have questions. All right, go ahead, Mark.
Okay, so let's see if there's other questions. Those are very, very powerful stuff we show you guys. I mean, like I said, we've done like 4 or 5 sessions with Kevin, and some sessions, especially the credit spread, I urge you guys to go back. I believe we have 3 hours of recordings on the credit spreads. You guys can look at stuff that we've done.
I see this one question about Iron Condor and earnings. So while you're looking at other questions, Mark, that might be good, let me give the parameters for Iron Condor for earnings, okay?
Cool.
So leave your option chain up, okay? So normally, guys and gals, when we're going to have earnings where it says company profile, all right, where the option chain is, there's something called MMM. It's called Market Maker Move. If you cannot find it, call the trade desk. They will help you find it, all right? What we're looking for is volatility that is twice the normal vol. On Apple, here, I see the front week vol is 28%, okay? What we're looking for is volatility that is twice that much going into earnings, okay? And what we get is a collapse in volatility. Is that 20? Oh, it says 23, okay? So for your parameters, you would want to have something that's double that. Okay, so what I'm seeing, Mark, scroll up so I can have the most, no, the other way, sorry. So I can have the most current one up in front of me. Okay, good. So what I've got is for, what I've got is for November, volatility is 23%, okay? So what we want is we want a volatility that's about double that, about 46%, all right? So just write double, all right? Volatility, double the normal. All right, and what we're going to get after earnings is we're going to get a collapse in volatility. Okay, so when you set up an Iron Condor, you set up strikes above the market, right, above current price, and below the market, below current price. Well, how far out do we set these strikes? Okay, 1.5 times the market maker move. If the market maker move is 1 standard deviation, then we want to sell premium about 1.5 times standard deviation, okay, away from current price. All right. So what you want to do is in the last 2 hours of the day, all right, right before the day before earnings, all right. So let's say the earnings are coming out tonight after the close, all right. Well, 2 hours before the close of the market, you want to go ahead and put on a put credit spread and a call credit spread, 1.5 times the market maker move. Okay, what the next? And so after you get filled on those orders, you want to put opposite orders in. All right, good till canceled. All right, closing out those spreads for a nickel. So let's say that we've got, it's something that, like Apple's got a 5-point wide spread above and below, and we've got, we've taken in $3.50 worth of credit. Okay, so what we want to do is on that put credit spread, we want to create a closing order to close that out for a nickel. All right, and on the call credit spread, you want to do the same thing. So you have closing orders. So the next morning when we open up, if price hasn't moved, right, instead of being worth $3.50, that the total might be worth maybe 60 cents. All right, and you just want to very quickly close those spreads out. All right. like on Tesla, what we had was we had max credit on the call credits side, and on the put credit, if you had sold 1 standard deviation, you were in a world of pain. All right, if you sold 1.5 standard deviation, it wasn't that big of a deal, and we got a bounce first thing in the morning. Okay, so we got buyers that came in. So the call credit spread went out for a nickel. All right, and so we got the full credit on the call side, and the put credit, we were underwater at the beginning of the session, but sure enough, when we got a 6-point bounce first thing in the morning, then all of a sudden, something we'd gotten $1.65 credit on was worth, maybe now 65 cents, and we just
Can
closed
I
that
can
out.
I interject
Yeah.
quickly on
Yeah, go ahead.
the Tesla and the stuff like this? Can everybody see the day trading zones members area? I want to show you something quickly, guys. That is very important. Tesla was where was the Tesla move? Here, that's the day. Look, Tesla report tonight for volatility crush. I will wait the close and play the stock after market and a weekly credit spread tomorrow. Not today. The stock is too crazy to take risk. Before report, it could easily make a new high or crush below 160. So best wait and see. Pass the report, execute, do not gamble. So play small, blah, blah, blah. The point of the matter is this. Look at the charts on Tesla. The next morning, what you have to understand, well, let's go on the options chain, and that you understand really how to play earnings. You have 2 ways. And we do it. Every trader does it the same way, by the way. If you look at Tesla's volatility range for the year, guys, you have 99% at the top, 23%. The night of the earning, Tesla was something crazy, everybody. It was like 150%, whatever it was, 180 or whatever. This is like a balloon full of volatility that is 150 times the high of the year. Do you understand, everyone? So even though at the open, people who were right on the call spreads are going to make a lot of money, the people who were wrong are getting killed. So you better come in the morning, see that the overall tone is bearish on Tesla, and I assure you that the first hour and a half or 2 hours of the open still have a lot of volatility to deflate. It's like a balloon. Psh, there's still a lot of air to deflate on the first hour after earnings. So here's how I play earnings. If I am sure, I do directional, or I do an iron condor, or I play both sides, or I do a double diagonal, but that's a little more complex. Or I just do something very simple, everyone. You wait the first hour the next morning, and you just wait for the retest. Look what happened on Tesla yesterday. Just gave you a gift. Look, Tesla. He did a cross-recross. He came and retested just yesterday at that 160. Yeah? And then he retested at the 151 this morning. It always gives you that retest on the zone that you're looking for to not gamble. Because the gamblers are the people who assume looking at their option chain, wrongly looking at 1 standard deviation and 2 standard deviation, oh, it's a sure thing we stay above 170. Those guys got killed. They lost thousands.
So the other thing is, too, that you mentioned, Mark, was that you can play it directionally. Well, we're not going to play it directionally this week because all of that volatility is collapsing. Okay, so if you're a premium seller, then you're making plenty of money. But if you're a premium buyer, then time is decaying and volatility is collapsing so much that even if you're correct on the direction, you would still get clobbered. So you have to go out to the next week's option chain, all right, which is not being affected by this volatility collapse, and trade your directional trade. Okay, so anyway, those are the parameters again for the iron condor into earnings. All right, and that 1.5 times market maker move, all right, is very quick and easy to figure out. All right, and though Mark recommended against that, if you happen to be playing that, that's how we played it. Okay, Mark, go ahead and pull up your day trading zones analysis daily commentary. Okay, the one that you just had up. this is really important. I mean, Mark's got 20 years of experience, okay? And so what he does is he does a recap, all right, of key support and resistance levels, all right? What we've got right in the middle of our screen here is ES1. Yeah, okay, good. So here are the levels of Emini, all right, and SPY, and those are the two primary ones that I'm looking at. But we also day trade Google and Apple, all right? So what we want to do is we want to look: are we in this cautionary zone, right, the yellow zone? Are we more likely to go sideways? All right, and are these levels close together? All right, if the levels are close together, we don't have what's called a tradable void. All right, there's not a lot of room to move, right, from one target to the next. So you're not going to make a heck of a lot of money, and you're going to be whipsawed. All right. That's why they call it the cautionary zone, because we say when you're trading directionally, use caution, because these targets are very close together. So we had a situation where for several days the market was just trading sideways, all right? And then just like a spring that uncoils, it opens up, and then all of a sudden we get some movement, all right? And so we're able to, the targets are much wider apart, so there is much more profit between the targets. All right, so pay attention to that. Mark puts this out every day, so I mean it's pretty straightforward stuff. Hey, we've got resistance at this level, we've got support down at this level. All right, and so we know where to initiate these trades. All right, so if you were selling put credit spreads, all right, at the end of the day today, going into tomorrow, then basically at the 514 level, that's on Apple, that's what Mark is showing right here, that's where we would be initiating that trade. All right, when price came down to the 514, we're trying to get our put credit spreads filled. All right, also back on the 6th of November, we had filled call credit spreads. All right, when price comes down and hits that 514 target, we are going to go ahead and close out those call credits. Okay, so let's say that we got $1.65. All right, and as price crashed down into the 514 level, well, that call credit spread is only worth maybe 45 cents. So we're going to buy that back for 45 cents. We put a $1.20 or so in our pockets, all right, and paid for the trade, and we're happy. We're going to move on to the next trade. We don't necessarily need to hold those credits into expiration. Okay, I mean, Thinkorswim will close out that trade at a nickel for no charge. Okay, so whenever you do put on a credit spread, right away, let's say that we're getting, just for even numbers, let's say we get 50 cents credit on, on a 2.5 wide. Let's say that we got 75 cent credit.
Yes.
Okay, for a 2.5 point wide, and price was just going crazy that day. You want to make sure that you, for that day, go ahead and put in maybe to buy it back for 35 or 40 cents. All right, and if you can double your money in one business day, right, in one trading day, then go ahead and close that trade out. All right, take the money, move on to another trade. If you don't get double your money that day, that's okay. Just occasionally you will, on like a 2 standard deviation move, you'll get a full credit for you'll double your money on a credit spread.
Typically, guys, me, I have a different take on the 5 cents things being free. Telling you the truth, guys, I couldn't care less if it's free or not, the commission at the end of the week. I know commissions are very important in spreads, but the bottom line is this. If I have 66 to 70% of the premium by Thursday, and it's a weekly spread, I'm out. I don't care. Because you hold, I've seen so many traders holding for that last 10 cents or 5 cents in their spread,
yeah,
and the
ridiculous.
spreads blow up in their face on a Friday.
Mm-hmm. Yeah.
And then that's a no-no in my rules.
Yeah, don't be a dick for a tick, right? Yeah. So if you get close, just get out. Just get out.
Yeah, 66%, 70% of the spread, the width of the strikes. You say, thank God, I had a great trade, and move on for next week.
That's right. Yeah,
So
redeploy that capital somewhere else. I mean, you're occupying an awful lot of capital, right, when you're doing a credit spread, all right, especially if you only got a $15,000 or $20,000 account, and you're occupying, $5,000 or $3,500 worth of capital in a credit spread. So, once you hit the targets, just get out, all right? These levels are where other traders are initiating trades or closing trades. Why would you not be the same, right? Go ahead.
Let's take 2 more questions and we'll wrap it up. It's over an hour and a half.
Good.
And Kevin just sent me a private. He said, guys, try to accelerate. So let's see which questions we might have. Good questions from Vincent. He says, well, I love spreads, but one losing spreads wipe out all my winners. That's not true. Most of the time, the reason he will wipe out the winners is because here's the mistake number 1 that I have seen over the years for the traders is they don't size properly. Meaning what? If it's a 1-point spread on the SPY and I do 10 contracts, I usually risk about $1,000. So let's say I want to consistently risk $1,000 at risk. Okay, guys, follow that because that's super important. Now, let's say you do a 2.5 spread and you do the same 10 contracts. Now you are risking 2,500 minus the credit receipt, so a little less, of course. Now, let's say you do a Google and an Apple and you still are at 10 contracts. Now you risk 5,000. That's the mistake that I see. Me, I risk the same 1,000, so I adjust my size. If it's 10 contracts for the SPY and it's a 2.5 spread, guess what? I'll risk 4 contracts here. If it's a 5-point spread, then I risk 2 contracts here on my spread. So if my winning ratio is 7 to 9 out of 10, I'm sorry, the mathematics will always make you a winner at the end of the month. Does that make sense, everybody? Because the gentleman who told me one wipe everything is because what happened is on the one that wipes out everything, he put the same big size, or he was so sure about the directional that he took too big of a size.
Yeah,
I'm telling you guys, he doesn't fail. He doesn't.
And that's
fail.
The thing too.
The guy who blows up in spread is because he takes too big of a size.
Yeah.
He's not consistent on the risk.
Good. So 2 things about risk management, guys and gals. 2 things about risk management. Okay. Consistent trade size. All right. Consistent trade size. All right. And trade location. All right. So how do I minimize my risk and maximize my gain? Okay. The probabilities in your corner so that it's not a 50-50 coin toss. All right. And wait until we are at the extremities. All right, of a range. All right, so trade location is so important. That bell-shaped curve that Mark came up with, all right, at the beginning of the presentation. Okay, the bulk of the transactions are happening at what's called a point of control. All right, or right at the middle of that bell-shaped curve. All right, what we want to do is we want to avoid the middle of the bell-shaped curve, and we want to trade the extremities. All right, we want to trade the narrow tails of that standard deviation curve. All right. Okay, so I hope that's clear.
Let's take the last 2 here. So hold on. We did Juan. We did Ashwin. Not sure about Ashwin on the debit spread here. Yeah. Understand not the high volatility effects of leadership, not the position. Yes. Well, the volatility is not going to impact your direction, but it's going to impact your premiums. Direction is directions. It's trend. It's the zone. It's the entire work around trend recognition, shift of momentum around your support and resistance, and your re-entries around retracement area that have high probabilities of success. Uh, Thank you. Good feedback from some of the guys. Do you look at historical volatility? Not really. Me, I'm looking at mainly 52-week high implied, 52-week low implied. I'm looking where I stand around the earning night, and I'm looking if I am low or high or below the average, and then I do my move. I'm looking at the right months. There's ways. Yeah, you have proper ways to execute the right month, the right strike. But those are fascinating. Options are the most powerful instruments in the world. People become billionaires and millionaires from options grant that they get in their companies. It's not it's not by coincidence. It is the fastest way to get wealthy with small amounts. You will not be wealthy with futures. I'll tell you, I've been around almost 20 years. I still use futures as an edge intraday to the gap. I still trade futures, but I trade futures with very defined purposes that are not most of my accounts. Okay, guys.
Let me give you
Go
an
ahead.
example of that. Mark says he uses futures as a hedge. All right, so let's say that he's long calls, okay, or that he's long the market during the day, all right, and we have some massive sell-off overnight. What he's going to do is he's going to get short the market via futures, all right, and use futures as a hedge, all right, to limit his losses, is what he's saying on that. One thing, I'll tell you what, don't beat yourselves up too much, all right, about trade entry. If you can get the direction correct, okay, and you are very strategic about whether you're buying or selling, and you take the trade down once you hit the target, all right, you can be sloppy on your entries. I don't encourage anybody to do that, but that comes with time, okay, being perfect on your entries, all right, but you can be sloppy on your entries as long as you get the direction correct and you take the money at the targets, all right, then you can be really successful.
Yep. And again, guys, it's a little hard to put 20 years plus X numbers of years in a bottle in 1 hour, but I think we've done a good job to spur your mind to think differently tonight about, oh yeah, I never thought about those SPY versus DS. Oh yeah, what about the credit spread? Oh yeah, what about doing my pre-market work instead of coming with my finger in my mouth at 9:30 trying to see where the wind is going to blow between the bid and the ask and losing money. We are trying to spur to you that this is a business. We work at it every morning. 20 years into it, we love it. We're passionate about it. And there's a lot of stuff you can look like on the Day Trading Zones website. We have a free PDF book that goes into the master support and resistance. It's free. You can get that with training videos that I show with real money. Some other concepts, the importance of paying yourself, the importance of realistic expectations as a trader. Traders come in this business and they want to make a killing before they are learning to trade and before they are learning to trade properly. And so there's a lot of people blowing their account before they learn. They learn. It takes time to learn. I was blessed to learn with the professional environment, and my job was dependent on it. If I was not listening to the rules and following the rules, I would have lost my job. That's how simple as this. Prop traders get fired every day. Hedge fund traders get fired every day. If you don't follow the rules, you are out. So you have a little freedom and leeway using your money, but it's so hard to make money that you got to respect it and come with an edge, because you want to be part of the 10% that shift money in your pocket from the 90%. And part of the 10%, just to let you know, part of those 10% includes the high-frequency trading system with nanoseconds of executions with direct access on the floor. And if you notice tonight, someone asked, do you use other charts than the 60? I don't. The 60-minute chart is my minimum time frame. Why? Because below 60 minutes, I'm going to be eaten and screwed alive by the high-frequency trading systems. Does that make sense? And if it does not, I'll explain that in a little bit more. Once the Tuesday night, we have a live event at 8 p.m. And again, you can get those free book. I think Kevin from Real Traders Webinar is posting the link. Training videos, free training videos and books that goes over that. I think that from the feedback we were able to give you tidbits that helps you think differently. That's really the way. If we have been able to do that with Kevin tonight, I think we've done our job once more to help you think differently about what you're doing right now.
Let's outlast the learning curve. And what Mark is saying is this is going to change the way that you see yourself as a trader. We want you to be more strategic, right? More confident in what types of trades you're initiating at what levels, right? And so we hope that we've done that. We really, like Mark said, we really enjoy what we're doing. We love it. We eat it up every day, and so we're glad that if we can contribute in some small way to you guys' growth and success as traders and individuals, that we hope that we've done that. Okay, so good night, everybody, and thanks so much for attending.
Thank you very much for taking the time to come, everyone. You have a nice evening. Take care.
Peace and be well.
Thank you for Kevin at the Real Traders Webinar to make us very active in the community.
Guys, thank you so much. And as always, I mean, you guys can see that, having real traders come in here and just, deliver value the way these two guys do, it's just unbelievable. And you guys can get even more of the value by, as Mark said, you could check out the podcast at realtraderswebinar.com/podcast. You could see there Kevin and Mark's previous presentations with Real Traders. You have part 1 and part 2, the first episode and second episode. And also go over to realtraderswebinar.com/DTZ free. DTZ free. And by going there, you'll get Mark's free PDF and also his video series on how to master support and resistance. And also, like Mark said, you can also sign up for his webinar. He's going to be doing another webinar on Tuesday. All right, guys, thank you so much, as always, for spending a Thursday night with us. And we look forward to, do you have a trial? Yes, somebody asked, do you have a trial? Mark does have a trial. You can get a trial for Mark's DTZ analysis, which they were talking about here. When you sign up for the free videos, you'll see there's a thank you